Hello and welcome to Smart Finance Investor. In today's episode, we're diving deep into the world of value investing strategies, a tried and true method to uncover hidden gems in the stock market. Whether you are a seasoned investor or just starting out, understanding value investing can greatly enhance your investment decisions. Segment 1. What is value investing? Value investing is a strategic approach pioneered by Benjamin Graham and championed by Warren Buffett. It involves seeking out stocks trading below their intrinsic value, which is the true worth of a company. This approach focuses on a margin of safety, where investors aim to buy at a significant discount to minimize risks. By conducting thorough fundamental analysis and embracing a long-term perspective, value investors aim to identify hidden gems in the stock market that have strong growth potential but are currently undervalued. This philosophy encourages a contrarian mindset, ignoring short-term market fluctuations in favor of a company's underlying fundamentals. Segment 2. The principles of value investing. Value investors follow a set of principles that guide their stock selection process. Margin of safety. Margin of safety is a fundamental principle in value investing, emphasizing the importance of purchasing a stock at a price significantly below its calculated intrinsic value. This cushion protects investors from unexpected market volatility, downturns, or misjudgments in their valuation. By leaving room for error, value investors aim to minimize losses and increase the potential for gains. This concept encourages conservative investing, where the gap between the purchase price and intrinsic value acts as a safety net. Fundamental analysis. Fundamental analysis is a comprehensive evaluation of a company's financial health and performance to determine its intrinsic value. This involves scrutinizing financial statements such as the balance sheet, income statement, and cash flow statement to assess factors like revenue, profit margins, and debt levels. Fundamental analysis also considers qualitative aspects like management quality, industry trends, and competitive advantages to form a holistic view of a company's prospects. This method aids investors in making informed decisions based on a company's true worth rather than relying solely on market sentiment. Long-term perspective. A long-term perspective is a central tenet of value investing, emphasizing the extended horizon over which investments are evaluated. Value investors aim to hold stocks for years or even decades, seeking to capitalize on the intrinsic value that might take time to be recognized by the market. This approach contrasts with short-term trading, as it aligns with the idea that a company's true worth unfolds over time. By focusing on a company's fundamental strengths and growth potential, value investors can ride out market fluctuations and benefit from the compounding effect of long-term gains. Ignore market noise. Ignoring market noise is a crucial principle in value investing, advocating for investors to remain steadfast in their analysis and decisions despite short-term market volatility and emotional ups and downs. Value investors focus on a company's fundamentals rather than being swayed by temporary market trends, news headlines, or prevailing sentiments. This approach prevents knee-jerk reactions and helps maintain a disciplined long-term investment strategy. By tuning out the noise and adhering to their well-researched convictions, value investors can stay on course to realize the potential of undervalued stocks. Contrarian approach. The contrarian approach is a key element of value investing, advocating for investors to go against prevailing market trends and sentiments. Contrarians seek opportunities among companies that are temporarily out of favor, often due to short-term issues. By doing so, they aim to identify stocks trading below their true value, offering substantial potential for future gains when market sentiment shifts. This approach requires courage, independent thinking, and a focus on a company's long-term fundamentals rather than following the crowd. Contrarian value investors believe that embracing temporary unpopularity can lead to profitable outcomes as the market eventually recognizes the underlying value. Segment 3. How to identify value stocks. Identifying value stocks requires thorough research and analysis. Here's a step-by-step process. Screening. Use financial ratios like price to earnings, price to book, and debt to equity to screen for undervalued stocks. Financial statements. Analyze the company's balance sheet, income statement, and cash flow statement. Look for signs of financial stability, consistent earnings, and positive cash flow. Competitive advantage. Assess the company's competitive position and moat, factors that give it an edge over competitors. Growth prospects. Study the company's industry trends, potential for future growth, and management's plans for expansion. Management quality. Evaluate the management team's track record, transparency, and shareholder-friendly practices. Segment 4. Real-life example, the Coca-Cola story. To illustrate these concepts, let's take a look at one of the most famous value investing success stories, the Coca-Cola Company. Warren Buffett began accumulating Coca-Cola shares in the 1980s when the company faced temporary setbacks. Despite challenges, he saw the brand's enduring value and its ability to generate consistent cash flows. Segment 5. Benefits and risks of value investing. Value investing offers several benefits. Potential for higher returns. Buying undervalued stocks can lead to substantial gains when the market eventually recognizes their worth. Lower downside risk. The margin of safety principle reduces the impact of market downturns. Focused on fundamentals, value investing encourages a thorough analysis of a company's fundamentals, reducing reliance on market speculation. However, there are risks. Delayed market recognition. It may take time for the market to realize the value of a stock. Value traps. Some stocks may be cheap for a reason, such as poor management or declining industries. Patience required. Value investing requires patience, as stocks might not immediately appreciate. So, there you have it, an in-depth look at value investing strategies. Remember, value investing isn't about quick gains. It's a patient approach that seeks to capitalize on the long-term potential of solid companies. As you venture into the stock market, keep these principles in mind and always conduct thorough research. Thanks for joining us, and until next time, happy investing.